In today's video, we're going to discuss purchase discounts and how they're treated differently in the perpetual or in the periodic inventory methods. But before we do that, I want to say I believe something great is going to happen for you today. Now back to the video. If you're someone who finds accounting confusing, go ahead and smash that like button so I'll know and the YouTube algorithm will know that you need more videos like this one. Let's talk about purchase discounts. I did a prior video in which I showed the purchase of goods or merchandise that was going to be resold by the company. If you missed that video, I have it linked up here, and following that are a couple other videos dealing with the returning of non-conforming goods and freight costs. But let's go ahead and dive into this one where we're going to journalize the following transaction. The company purchased merchandise on credit for a cost of $4,500. They returned $300 worth of the non-conforming goods. They paid the remaining account payable balance within the discount period and received a 2% discount. That's the transaction, that last part there. We're going to journalize that in this video. So let's first think about the accounts payable. And we know the accounts payable account is a liability account. And so that goes up with credits and down with debits. So the original amount purchased was $4,500. So that would be a credit balance in there of $4,500. They then returned $300 worth of non-conforming goods, and they received an allowance for that. So in a prior video, we showed where that was, and that video is linked up here, where we debited accounts payable for that $300 allowance. So that means we have a balance now as of this transaction of $4,200, and that's a credit balance for accounts payable. This is the amount that's going to be paid off in this transaction, but they receive a 2% discount as well. So let's take a look at how much that would be. So we would have a $4,200 balance that we're paying off, and we receive a 2% discount. So how much is that discount? We can put it into a calculator, and we had $4,200 is the remaining balance times 0.02 gives us an $84 discount. And that means that they only have to pay $4,200 minus $84. So the amount they owe at this point, and I can just do that by changing this to a negative and adding the 4,200, that means they pay $4,116 cash. That's the amount of cash they'll have to pay, because they are receiving an $84 discount. And the reason they're receiving the discount is they're paying within the discount period. Oftentimes, a company will offer terms in which they will offer a discount of a few percentage points if the customer pays within, say, 10 days. And so many companies will take advantage of that because 2% is a big savings when you consider that they can do this repeatedly for each purchase. So let's go ahead and do this for the perpetual inventory method. In the perpetual inventory method, we're going to have accounts payable, and we're going to debit for it for the remaining balance. And as I showed up here, the balance at this point is $4,200. So we're going to go ahead and debit that out to reduce that to zero. So that's the full amount owed at this point is the $4,200. We're going to debit that. But I told you that we're going to pay cash of only $4,116. So we're going to credit cash for $4,116. As you can see, they don't balance. So we need another entry here to show this $84 discount. And in the perpetual inventory method, we're going to use that inventory account. We're going to credit the inventory account for that $84. That will reduce the cost, the carrying cost of our inventory by that amount of the discount. And the $84 will then cause this transaction to be balanced, and you have now properly accounted for a purchase discount in the perpetual inventory method. Now let's talk about the periodic inventory method. We're going to have the same exact transaction, so everything leading up to this point is the same. It's just how are we going to modify our journalization of it. In the periodic method, we're still going to have the accounts payable debited, and that's for the balance of the $4,200 that's sitting in that account. And our cash payment, which we're going to credit cash, remains the same, $4,116. The only thing that will change is that discount. We still know it's $84, but in this method, in the periodic inventory method, we're not going to credit inventory. We're going to credit another one of those temporary accounts that the periodic inventory method is famous for, called purchase discounts. So we're going to credit purchase discounts for that $84 discount. And now you have properly accounted for a purchase discount using the periodic inventory method. If you like this type of information, you may want to sign up for my free newsletter updates, and you can get those at askprofessorcapko.com. Now you know quite a bit about the perpetual versus periodic inventory methods, but there's more you need to know. So please subscribe to my channel and click that notification bell so you never miss a video. Thank you.